All right, we are back and we are live. Another AppliedMMT live stream. I have Ty back with me. It's gonna be a good stream this week. We have some fun things to go over. Already some good questions in chat. We will definitely get to those as well. It's gonna be a bit of a potpourri update live stream, potpourri bag of questions. So if you have any questions, by all means get them in chat, and we will definitely address the questions. What's going on, Ty? How you doing, man?
I'm doing good. We are let's pretend like we haven't talked in a couple weeks. So yeah, I'm doing really good. A lot of great things are happening. I feel good. It's good to see you again, Doug. It's been so long.
The same. That's Ty's way of saying that we spent about 4 hours today troubleshooting an issue that in reality would have taken about 15 minutes to fix had we known what it is that we were attempting to fix at the outset, which we will show a little bit later on in the stream. Look, whenever I go radio silent on Twitter, X, or YouTube, and it's been a week or two since we've done an update or a live stream or anything, it's probably because we've been in the kitchen cooking up something good, and we've got something to show off tonight. And yeah, I'm excited to show it off and start talking about some of the things that we've been doing. I know all of you are going to be excited as well, and so yeah, Ty and I have seen a lot of each other over the last 2 weeks, but actually, I mean even more than that. But I think it is. Yeah, I think you guys are going to be excited for what I got to show off. I'm just making sure all the streams are running on all the platforms. All right, I think we're good to go. Maybe we're not. Who knows? Oh, there we go. I think now we are good to go on Twitter. All right, chat. Peter, welcome. Ozzy, welcome. Dan, thanks for stopping by. I agree that MMT fundamentals are the only way to position yourself. Yeah, I agree. Flows dominate. Absolutely. Good evening from Lakeland, Florida. Kevin, thanks for joining, man. Thanks for joining. Balkinski, Bick, welcome. Ty got the model, but cannot figure out what happens to the U.S. running a constant deficit. All right. All that sort of stuff we can definitely approach tonight or broach as a subject here. Let's get into the fun stuff though. What do you think? What should we start off with? I'm also checking to make sure we're good to go on the stream. Okay.
I think we should actually just start off. If you're watching on X, formerly known as Twitter, make sure you hit the retweet button like I just did.
Yeah. Appreciate it.
Make sure you do that.
This would be the night to especially if you are a orthodox or a kind of mainstream economist. Tonight would be the night, if you're ever going to watch one of our live streams, to pay attention, to see at least what we think is the next evolution of macroeconomics really is, and how do you actually model macroeconomics. Because like I said, we will show off one of the projects we're working on, and we'll dive a little bit into that. I think we can actually start off. Peter, right out of the gate here, had a pretty good question in terms of, can you address the part-time versus full-time employment trends, discuss the total interest payment, debt as a percent of the Fed budget, and what you expect this to look like into the future. And I'm going to tie in something else that I just kind of want to discuss tonight as well, that does dovetail a little bit into employment, and I'm just gonna bring them all together: employment, inflation, where we're at in the business cycle, just the things that are kind of most important to me right now that I'm watching beyond just the day-to-day flows, and where we're at with positioning for actually investments and whatnot. And that really is this whole idea of where are we at in the current cycle. And one thing that I thought probably would have showed up by now, and certainly hasn't showed up by now, is I've been expecting, and I'll go ahead and transition over to that screen. I've been expecting a bit of an echo pop in inflation. And if anything, over the last year, so going back to June of 2023 until the July print, so a year and a month, inflation has been flat. I mean, almost to almost to the point, completely flat. And certainly over the last 3-4 months, we continue to see inflation falling lower. Now, this week we have inflation coming out on Wednesday. CPI going to be a big print, and of course that's going to come just a couple days before the Fed announcement. I think it's the following week, if I'm not mistaken. Let me see real quick. The 18th. So the following week, the FOMC is going to meet, and we'll know where interest rates are at. So this Wednesday, 2 days from now, well, not even that now, less than 2 days from now, we're going to get the CPI data, and that's going to be one of the more important data points that, really that we've gotten in quite some time because of the implication. And one of the things that I've been thinking is, hey, at some point, this higher interest rate thing eventually paves the way for higher inflation because of what Peter had kind of pointed out, which is there's a massive amount of interest payments that are hitting the private sector. And one thing that I will certainly agree with across the board in terms of kind of economic theory is, if you just print a ton of money, eventually that can become inflationary if you're at the right part of the business cycle, and there's the ability to chase up those prices. So Ty, if you want to jump in here and maybe kind of explain some theory on inflation, maybe explain some ways to kind of think through the various input and kind of the causal chain of inflation. I'm going to pull up a few other tweets that might help this discussion as well, and give us some thoughts there.
Well, we've got, I think the newest data out is real investment has been revised upwards. So if we kind of look at that perspective, real investment is, machinery, factories, the productive things we use to make output in our economy. So if that's ticking up and we're at the bottom of a cycle, we're also seeing, I believe, Doug, we're seeing some wage growth. Was that a chart?
Yeah. We'll pull that up in just a second. Yeah.
So we're seeing the beginnings of some wage growth. We're seeing the very beginnings of firm markups, which are all indications that we are probably at a bottom in the cycle. Of course, anything can change. An asteroid could hit us tomorrow, and none of this matters. And if we go on that assumption that we are now trending back upwards, that would suggest with some sort of lag that we are probably going to see an uptick in inflation. And that's looking at it exclusively from the production side of the economy. And that's not factoring in what the government does with interest payments or normal government spending.
Yeah, so from the inflation standpoint, one of the things that I was very curious to see what would happen is it's like there's a couple dominoes that have to fall. And we discussed this 2 or 3 weeks ago when we had our inflation discussion, just about how when the pandemic hit and we had the knock-on effects that lasted years later still to this point, and we had that big inflation wave. We had the kind of the initial cause of that inflation wave was this concept of markups, and there's no doubt that that's kind of a part of the cause, but there was also obviously a massive amount of government stimulus that allowed the chasing of those prices to go higher. And we discussed in that entire update how that then created more profits, which then created more investment and pushed the private sector up the investment curve to even create more production, and then you get this ebb and flow, which then ultimately helped kill inflation. And now it looks like we're starting that next leg higher, and certainly the blue line here, which is our kind of synthetic markup track, started ticking up last quarter. And what we were waiting for, at least what I was waiting for in this specific kind of paradigm of understanding inflation, was average hourly wages, because once those start ticking up, it's very, very clear that the endogenous wheel that churns inflation higher is moving. And as Ty was just mentioning too, look, any exogenous shock can happen and knock us off the endogenous path of the underlying system that generates the sort of outcomes, right? So assuming we don't get an exogenous shock, endogenously we're starting to see the various pieces come together where we can start to expect inflation to push higher. And what'll happen is you'll get a month, and it doesn't, I'm not necessarily saying Wednesday is going to be the day, but you will get a month where inflation isn't necessarily supposed to be higher year over year on Wednesday. But the point is, if you get a surprise to the upside, that means, because the rest of the kind of the macroeconomic analysis landscape, they don't understand the endogeneity of the system and what drives the system, right? They can only look at the data they have today and predict, okay, based on the data today, what is inflation, or what's the inflation print supposed to be relative to last year? And so all the analysts will do that. None of their models actually take into account the fact this is an endogenous, there's endogeneity to the business cycle, and that is where the surprises happen. And it's, if you get a surprise to the upside, that's how you know that the mainstream just doesn't, that they're on the wrong side of the call here, and that if we do get a big surprise on Wednesday to the upside, and again, it's not necessarily that we're going to see an acceleration. I mean, right now the consensus is pretty far away from an actual acceleration year over year, but if we do end up getting that surprise to the upside, that's how you'll know, okay, wages are starting to put upward pressure on inflation, markups are starting to put an upward pressure on inflation, we have ample income coming from the interest channel into the private sector, so those prices can be supported and we can have a business cycle take off. That's all happening. And so again, my call isn't necessarily for the print on Wednesday to be hotter than expected, but certainly by the end of this year, I absolutely expect to start to see some of these hotter than expected prints. And then as we head into 2025, it's not going to surprise me at all if we start actually seeing inflation push higher. Now, the last thing I'll say about this, the big kind of exogenous shock that can come in and shake the endogenous cycle off its path is oil. And oil has been right around that $70 mark and plummeting from where we were at, say, even just back as early as late August when we were getting close to $80 a barrel. This is the big thing. As long as oil stays relatively flat or even pushing lower, it's going to be very hard for inflation to take off and do just a ton of damage in any immediate sense, right? And kind of the impact on the macro cycle of inflation will be relatively muted as long as oil stays lower. But if oil starts end up pushing higher and producers end up asking for more and more, and my understanding is, I don't follow the day-to-day headlines of oil, but my understanding is OPEC isn't exactly agreeing on a target price, and there's a lot of discussion on that end of things. If those end up getting resolved and there starts to be this push higher in oil that kind of follows inflation up, then we could start to see that reinforcing cycle, the feedback loop into inflation pushing higher. So I do expect inflation in the not too distant future to start to show some hotter than expected prints, and then ultimately just start to push higher as I think the full effect of the interest rate channel is finally going to be seen. Ty, I don't know if you had any other pieces to add to that.
No, it's very important to look at energy, and especially oil, because it's the biggest component of energy at this point in our societies. And you can also look at it much like a productivity shock. So as oil prices go down, productivity technically goes up because it's such a big input component to production. So essentially, companies, all the workers are using energy to work, right? So if energy goes down, right, their productivity per laborer goes up, and that will actually keep inflation down. So we can see a bump in the business, right? Like we are seeing, right, real investment go up. Inflation rates kind of stay at a level pace or even drop with energy, right? It's such a huge input component to production. It's a real good advanced indicator that you can kind of apply to a larger macro model.
Yes. I like it. I'm reading chat right now. I appreciate that. Well, let's see. So you're saying the Fed rate cuts will not offset exogenous factors? Yes, Dan. We can get into this a little bit. I don't think a 25 basis point cut here will really affect that much. I think we pulled this up last week or 2 weeks ago, and I posted it on Twitter as well. But currently, the average interest rate of all outstanding debt right now for the U.S. government is like still 3% or 3.5%, right? And the Fed funds rate is 5.5%, right? So even if they were to do a 25 basis point cut, I mean, there's still a lot of room for the new debt that still has to be rolled out to push out at that higher rate. Now, granted, a lot of the debt that obviously gets issued is short term and is probably already almost caught up to that full 5.5%. But yeah, I don't see a 25% basis point cut really, shaking us off the current path. If oil stays flat enough for long enough, then maybe we don't get the pop in inflation that I think is very possible here. And maybe the Fed decides to cut more into the future off of the fact that inflation stays relatively tame. I could easily see that end up happening, and maybe then you could start to see the snowball, if you will, pick up and turn into, just from a small snowball into an avalanche of kind of flattening that interest income. But right now, I don't see a 25 basis point cut really affecting that all that much. Let's see. The next thing I wanted to jump to is I wanted to go back to Peter's question too, just about employment real quick. And actually, I'm going to pull up one other chart and then I'll jump into that. And with regard to employment, I've been paying close attention. I feel like the person that has had the best take on this is a buddy of mine, Ben Kizemchuk, and his whole point is, and I mean, you can read over his thread really for the past 2-3 weeks. I hope you guys can't see that. You guys can read over all of his posts for the past few weeks here, and his whole point in a lot of this is that I'm trying to find like a really good post recently where the real impact is of the recent drop in employment has been just because we've been getting such an influx of immigration and an increase in labor force participation, and because of that, just because more people are entering the labor force and not enough jobs are opening up to offset that, that's going to raise the unemployment rate. That's been his argument, and I think it makes complete sense. In part, so I don't even need to know that piece of it, right? So I mean, go check out his Twitter post for the last couple of weeks. I don't even need to know that, because even if I didn't have that information, all I need to look at is where we're at currently in the credit cycle, right? And we are just starting off the next boom in the credit cycle. We had the big washout after 2022. We had the massive decline in government spending in 2022, which crashed the credit cycle, which got us near a recession in 2022. But now we're reaccelerating, and it takes quite a few months, even into years, for these credit cycles to play out. Now, if we were seeing unemployment jump late cycle in a credit cycle, so I mean, just going back to say like 1990 into 2000, if we had a credit cycle like that play out, or a credit cycle play out like we saw heading into 2008, if we were pushing a lot higher in the acceleration of credit, and we started to see unemployment tick higher, if both of those was happening at the same time, then I'd say, yeah, we probably need to look at what the heck is happening with unemployment pushing higher here, because that is then a sign that layoffs are happening at the top of a credit cycle, and they're happening because of the endogenous components in the cyclical business cycle dynamics, and that is the cause of the unemployment. The other thing too is if you also look at wages, the wages that we were looking at out of the gate, which continue to fall and are now ticking up, again, they peak at the top of the cycle, and it's when unemployment starts to push higher as wages push higher that, again, that's when you want to be concerned. And we're just starting to tick higher in the wage cycle. So we're just not at the point of the cycle where we would be concerned with unemployment pushing higher. Furthermore, I can just, let's see if I can, is there one here? I'll just pull it up. I don't know exactly what explains this, but if you just look at the unemployment rate after the 1990 recession or the 91 recession, unemployment continued to trickle ever so slightly higher. Same thing in the 2000 recession. Unemployment took a while before the next business cycle really took over. And I know we didn't have a full unemployment pop in 2022. We never had a technical recession, but from a cycle standpoint, we had government spending completely collapse in 2022, and we had the credit cycle completely collapse. For my money, it was a stealth recession that we had in 2022. We just never had the layoffs for whatever reason. And so it almost feels like we're getting just kind of that natural progression that has played out 2 out of the last 3 recessions. And I don't know if this is just people, maybe this just is a function of inflation pushing higher, more people are entering the workforce, there's just a demand for higher income, and that's part of it, and that's why the labor force participation rate is ticking higher. A lot of different explanations for exactly why we're seeing unemployment tick higher that aren't necessarily a sign of a recession. And I think again, when you look at the first drivers, the beginning of the causal chain, that being flows, we're just not in a position where flows are indicating that we should see rising unemployment as a concern of a looming recession. I don't know if you want to jump in there, Ty, in any of that.
Yeah, no, I think you highlighted the most important fact is to look at the labor participation rate. I have a big influence on that. And plus, it's employment itself is a very lagged variable versus actual production. So when production starts going up, people that are already employed in factories, and we'll just look in the micro level, they're just asked to produce more before more workers are vetted and qualified and get hired. So it's always a lagged indicator. And you'll notice that even in that chart there, in pretty much the 3 last recessions, unemployment continued to rise even after the recession was over. So production had all picked up, right? But the workers in the economy, and maybe it's easier to look at the firm level, they're just expected to work a little harder until the new workers are vetted and hired. So it's always a lagging indicator in the endogenous a private sector production model. So when I see that, I don't put a lot of stock in, oh my goodness, inflation's or unemployment's going up. If anything, it'll probably level off pretty soon, obviously, barring any exogenous shocks.
Yeah, that's helpful, man. That's helpful. Good thoughts. Good thoughts. Someone pointed out in chat just that loans and leases has been effectively flat since would that be March? Yeah, 100% agree. So loans and leases, which is going to be more correlated with the productive part of the economy, is pretty darn flat. We did start to see maybe from say March until July, maybe a little bit of a sign of acceleration, but certainly that's flattened out over the last few months. And one other thought too that I've had is, there's so much money still left in avenues of private credit, right? So now I'm talking about non-endogenous money creation. So much of the interest income that hit the private sector is still finding its way, I don't want to say off the sidelines, but it's finding its way into more productive uses via private credit. And so there's definitely a path that can happen. And I think it's part of the explanation why we haven't seen the necessity yet for just a massive acceleration in bank credit, and then everything Ty was just saying as well. I mean, in loans and leases of bank credit, and I think we're still waiting for that next big push higher to start the next cycle, which will also be when we finally see that kind of all of the ingredients together in the pot for inflation to start to emerge as well. And I think this is in the next couple months sort of thing, not the next 6 months to a year. So I don't think we're too far away from seeing these things emerge. I hope that answered your question. Let's see if anything else is popping up into chat. Yeah, Dan, I've seen your cyclical work, and I agree. I mean, I think we could definitely see this cycle continue to push higher into 2026. I agree. I concur. All right, let's see, Ty. One of the other things. Do we want to have the Fed fund rate debate? Do we want to do that?
Yeah, one thing I was thinking, do we have any, you probably don't, any graphs prepared on firm profits? So that's another big leading indicator on, where the credit cycle is going to go. If we look at it from a Minsky type, perspective, as profits go up, so does the story of firm credit.
We do. So there is, and maybe of a better read on this, but there is. I'll go back here. Corporate profits after tax is tracked quarterly, and so we saw that drop in 2022, and then started picking up into 2023, and we started to push higher after that.
So if you look at it from a causal perspective, the next chain in kind of this, if you look at it in a big loop of the economy, the next chain is real investment. And we are now just getting early reports that real investment is on the uptick, right? So if real investment goes up, it means your capital stock goes up. That means there's going to be more output, more employment. So it's just another piece of the puzzle right there. You can't take any one piece and say that's the bullet. That's going to tell us everything. But that's more evidence that we were at the bottom of the business cycle, bottom of the credit cycle, and if you look at that, that's been a couple quarters. It's a couple quarters behind. Is that the second quarter?
Yeah, second quarter 2024. Yep.
Yeah, so it's already, and I imagine it's gone up in the third quarter. That's already 3 straight quarters of profit growth.
Yep.
So it's just more indicators that we're on the upward path.
So this already is a flow. So this is going to bastardize it just a bit. If I do percent change, I guess now we have acceleration. But if we do acceleration and then we overlay this, and I'm going to use the BIS. So let me go back to Fred. BIS private debt. Let's pull that up. And I will get this time series. Whoops. We'll get that time series. And then we will put this on the right axis, and we'll scroll on in here. So what you're saying, Ty, is, so the guys and gals watching, I'm gonna make these 3 so they just show up a little bit bigger. The red line is year-over-year credit, and now the blue line is effectively acceleration of profit, right? And so we have the acceleration of profit in, say, 85, which caused this nice, tiny little pop here, reacceleration in credit heading into the 91 recession. We had the increase of profit heading into the dot-com bubble starting in about 93 to 94 to 95, which then started the dot-com bubble. We then had the acceleration of profit that kicked off the great financial crisis bubble, and then the acceleration that kicked off the post-great financial crisis period, which really wasn't all that much of a credit expansion. And then we had more recently the pop in kind of this now almost double pop of of profits that I think we think now, if the correlation here tracks, will kick off the next credit cycle. So yeah, I think this shows exactly what it is that you just said. That when we see these accelerations of profit, that is a good indicator that we are going to get a follow through of an increase in private credit, and that is the next step in the cycle of the business cycle, which is, as Dan was pointed out in chat, probably by 2026 ish is when we could expect the kind of the natural evolution of something like that to go ahead and flatten out.
All right, let's do ZIRP.
You want to talk ZERP? Okay.
Let's talk ZIRP.
I do have, I'm going to answer Big Dog real quick. He's saying, what is gold telling us and what's its upside here? And I don't follow gold all that much anymore, but one take that I heard that I think is a pretty darn good take is this idea that gold does really, really well when there is a lack of safe assets, and then there's like kind of this lingering effect that it's almost like a I don't want to call it animal spirits, but it is kind of a more speculative effect. And once you start getting a deluge of safe assets and kind of the credit cycle kicking off, which I think we're about to, all of a sudden gold starts to become a little bit less intriguing as a safe asset replacement. All that being said, it wouldn't surprise me if we start seeing kind of the top start to form here in gold for this cycle. But again, I'm not. I mean, gold is not my thing. So take that. Take that for what it is. All right. Are you ready to talk ZERP? This is so when it comes to interest rates and just kind of what interest rates do. This is one of the things that Ty and I have been discussing quite a lot. In part because I just don't think, I mean, if 2022, 2023 taught us anything, it's that clearly mainstream orthodox, even a lot of heterodox economics, they just, like, everyone got 2022, 2023 wrong, that the rate hikes were just going to crush the economy, right? And the question is, what's the impact of that? And then also, MMT, I mean, certainly Warren Mosler has made the argument that we should have a permanent ZERP. And I know, Ty, that's something that you've been thinking through yourself, modeling yourself. And there's also the argument, on the other hand, that whenever we've, the one time we've been in ZERP, we never saw really a real credit cycle take off. Growth was very slow. It was very hard to ever kind of get the economy, booming again, so to speak. And so there's that side of it. So you have these two kind of competing arguments that I think both, the pro, we should have rates at least at 3, 4, 5% argument would be, for some reason, that does something that induces a desire for credit expansion, that induces some sort of competitive desire in the private sector, that creates these kind of credit cycles that are important for kind of capitalism to thrive and whatnot. On the flip side, though, you could also just say, but we can do all of that just through the government channel, right? Just through the fiscal channel. We don't need, all the benefits come from the interest income channel, and those can all just come directly from fiscal spending that would get you the growth that you would need. So those are the two pieces of the debate. Ty, I don't know if you want to add anything to that description, and then kind of just say your thoughts on this. I'm going to sound like a politician here, because I was not necessarily in favor of ZERP as a policy, but the more I built out my national model, I just realized, for one, it's just a mechanical reality of both the New York Fed, and we'll just speak in the United States terms, the New York Fed and the Treasury coordinating operations. If they just stopped, let's say they just stopped, the Fed decided, I'm going to buy a fixed rate of
of treasuries out of the banking system to support monetary operations. And the government said, I'm just going to have a fixed level of spending. Rates would drop to zero.
Yep.
Simple as that. So on a mechanical, I know the argument, the philosophical argument is, well, if government doesn't create the market, the natural rate is zero anyways. There's that argument, but now there's another argument. You can look at a dynamic model and see that the rate tends back down to zero mechanically without intervention, and it's actually intervention that would actually push the rates up. Yes. And I know that's counterintuitive, but once Doug and I talk about what we're going to talk about in a little bit, people are going to be able to actually explore that for themselves and develop that understanding of why the reality is completely opposite to what the mainstream says, or some schools say that, you know, the Fed is artificially pushing down rates when that's just the mechanical level it's going to drop down to zero. Now, as for the other side, and Doug highlighted it both, right? There's the other side. Well, hold on. There's this really regressive fact that if the government debt to GDP ratio is extremely high and rates go up, that is inflationary. That is giving, you know, that's giving juice to the private sector in the form of financial assets. And have I bought into that completely? No. This is probably where Doug and I might diverge a little bit, although both of us agree that's very nuanced in a lot of cases. So my issue, obviously, is in the private sector. We have not just a policy rate and interbank rates, we have, you know, market rates that firms are borrowing. They have to pay interest. That interest is a cost. That interest lowers profits. Profits go down, that's less chance for those firms to invest, and less investment, the old story, less output, less employment. So there's that argument. But what I'm watching and where I'm being convinced by MMT is during periods of high government debt levels, that interest income channel might overpower the traditional effects that we would see that I described with a firm having higher cost on interest payments. So that's kind of where I stand. I think Doug and I are pretty close, but we definitely, if for entertainment purposes, between Doug and Ty, that's where the entertainment is, and we're not far apart, but there's nuanced differences, and it's dynamic and it's changing all the time, and I'm watching. And my opinion is evolving, and that's why I say I'm kind of going to sound like a politician. Keynes always said, you know, if something presents itself, and I'm paraphrasing now, and it's, you know, definitive proof, I will adjust my thinking, because my ego will not trap me into a specific school of thought permanently where I end up being wrong in the future because I'm stuck with some bunk textbook theory.
I like it. I think one of the things too, I mean, this is, we'll jump in just a second too, everyone, to show you guys the tool that we're working on. And actually, Ty, I'm wondering, can we show actually in the model, in the version that we currently have available, like change the central bank, how many bonds they're buying, and actually show how that, I think we can actually demonstrate this exact principle with the current version of what we're about to show off here and tease. Okay, so we've if you guys have seen Ty's national model, what we've done, Ty mentioned this, we'll show this all off in just a second, but this will give some complete context to everything. We've completely ported Ty's entire national model that he built out in MMT. Ty, it's like something like 100 and some odd variables, 80 some odd stocks. How many? Like 1,000 feedback loops. I mean, the thing is massive. You still have do you still have the video up on here? Yeah, go ahead.
Hold on, 1,000 feedback loops. Doug is off about 36,000.
36,000.
Close enough. Yeah. So the system dynamic models You can't really judge them on size because some models are dominated by feedback loops, like my model. Some models are dominated by 3,000 variables, but maybe only 2,000 feedback loops. So there's no judgment, but the focus of this national model is something that where economics falls flat is the dynamic connection between everything in the economy. So instead of thinking linearly, where A, B, C, and then you've got your results. We're saying no, A, B, C, D, oh, and D affects A, right? So that was kind of the big focus for my national model. And sorry, Doug, I cut you off.
No, it's fine. It's fine. No. I'm glad you gave a little context. I was what I was trying to say is the thing is massive. And I think you were just trying to make sure that it was qualified correctly by what I meant by massive. So, anyway, we've got this model, and one of the things we've done, and one of the things we're continuing to do, and part of kind of the long-term plan with well, what the hell? I'll just pull it up, and then y'all can just kind of look at it for the time being. So real quick. Do you want me to? Yeah, go ahead and give the qualifiers for everything we're seeing. I'll give some as well.
Yeah, well, no, I think it's just an outline like of what we're trying to do here. Ultimately, we're Doug and I. The novel thing that we will end up doing is combining deep learning with complex systems. That's the ultimate end goal.
Yep.
And what we kind of evolved to is pretty much there's going to be 4 separate models, the MESSSI models, and I'll let Doug abbreviate that for everybody because I forget the abbreviation. Let me hold on, Doug.
Yeah, go for it. Go for it.
Monetary?
Not even close. No.
Okay.
Yeah.
The two things that matter is system states. That's what really matters.
Yeah. So, one of the things that I've been doing for quite some time is developing deep learning models to understand kind of macroeconomic outcomes. Ty obviously has done all of his system dynamics work. I've always known that those two can very much go hand in hand just in terms of building deep learning models informed by the sort of things that you learn in dynamic systems, and that those help the learning models learn better. And as we understood what we could make out of this, we really understood that we could make various versions of, qualitative and quantitative predictive models to understand qualitatively how a macroeconomy should run. And then with that in mind, when you are poking at your theory, once you have your theory down and it's properly defined in a system dynamic situation, which Ty did in Minsky, you can then apply a layer of machine learning and deep learning to target even more into taking that from a qualitative model, which is what the Q and MESSSI stands for, and bringing that into an actual predictive model. Getting this now full circle back to the debate that Ty and I have been having just internally, there are hundreds of variables and there's hundreds of parameters, and each one of these parameters can tell you something about the reality of the macro behaviors that are taking place. And if you get those right, you're just going to get a better model. And the debate that Ty and I are having when it comes to interest rates with regards to new credit expansion is that whole dynamic is a very complex dynamic. There's a lot to describe what's going on, and even the slightest change in some of those descriptions can have a lot of very different outcome given a change in even just the smallest parameters. And so the big point Ty is trying to make is, hey, when you raise interest rates, that is an immediate higher cost for firms, which definitionally slows down their rate of investment, and the desire for the rate of investment takes away from profits and it brings them down the investment curve. But my argument is, and I don't know this, okay, one of two things is definitely happening. Either one, when the Fed raises interest rates in a high public debt to GDP ratio scenario like we're at right now, it is such a massive wave of income, which it is. Without a doubt, we had a global shutdown for 6 months, a complete hit of the reset button, post-COVID, and the effects of that were essentially nil because the government, the U.S., sent out almost $2,000 or whatever directly to every citizen in the United States, and there's like $2 trillion or something like that. It resets the entire system, allows profits to do their thing, and the whole system gets back online after the largest shutdown in modern human history of the entire global economy. And maybe it is just the income hitting the private sector that really just does it, and because the interest income that we've seen over the last year and a half is essentially the same amount that we saw during COVID. That's just been because of the higher interest rates. Maybe that's been it. But maybe there's something magical that takes place to the things that we would call the parameters that describe the causal chain to why do firms decide to get a loan versus not get a loan. And that's really where the debate is going to be. Either one of two things is happening. Yes, if we were to rerun the high interest rate experiment when government debt to GDP was at 0% as opposed to the whatever 120% it is right now, and I think in Ty's conclusion, if we could rerun the experiment, all things being equal, which we're going to be able to with the very tool you're seeing on your screen, we'll be able to figure this out. If we reran that experiment at a zero, a near zero level of public debt to GDP, Ty would say that would collapse the economy. I would say, I don't know. I would lean towards, I don't think so. I don't actually think it would, but the good news is we're building the tools that no one else can build. Well, maybe they can. They just don't want to build, and that's a question we're going to answer. So that's really where the debate lies. Ty, I talked a lot there. I know you're probably wanting to get some thoughts in as well, and then we'll talk about what MESSSI actually is.
Yeah, no, I just want to answer. It's Shifty Paradigm is asking what effect the policy rate has on commercial rates. And if you want to just look at it in aggregate, it's a floor, essentially. So commercial rates will not drop below the policy rate because banks are lending to each other on the interbank market, right? So they have to pay interest to each other. If they're making loans in the market to the private sector, right, that's great, and they'll make interest back, but it has to be above the rates they're paying in the interbank market. So it's effectively, it's not an official floor, but it's effectively a floor. And if you push that floor up, you're going to push all the downstream rates up in the economy. So that's the direct aggregate effect. And that's what I wanted to say, Doug. I saw that question and I had this urge to answer it.
Good.
And yeah.
Good answer. Answer. All right, so we're going to show off MESSSI. What does MESSSI actually stands for? It is the Macroeconomic System State Simulator. It is Ty's national model into a web app. Now, Ty made me promise that I would give quite a few qualifiers before we show this thing off. This is very much a work in progress. What you're seeing right now as well is our admin version of it, and this is not going to be the final interface that, yes, shot macroeconomic system state emulator. But then, I might actually take that because then it could just still be MESSSI, but the E is different. But we are simulating. It is a simulation, not an emulator. So
it's not emulating another simulation. It is the
simulator. Our vision, Ty's vision, I guess, specifically for what is in, eventually what we want to get to in terms of a user interface. Again, on our version right now, we're still going through each one. This is every parameter that we can set in the entire model right now, and I think we can even add a couple others that we still need control over. And so we're still tweaking everything to get it ready for all the versions that we want to create, so people can have control over this and run the simulations. But definitely the one that, and this is too, when Ty and I started up, he's like, Doug, this is my passion project. We got to get a free version out there just to have control over, and go look at this model called En-ROADS. Create that, and this is what we've been creating. This is why I've been kind of quiet on the social front, socials front, because we've been we've been creating, essentially this. So the whole idea is you're going to be able to simulate various scenarios dynamically, on this server, and the version that is just going to be kind of for public consumption that can hopefully help us all kind of win the debates of, no, this is how you do macroeconomics. This is what we ultimately want to finish on without the light white background that burns your eyes when you look at it. We'll do the cool trendy dark background. But with that being said, I mean, this is what we're working on, and we can kind of show off a couple ideas here. One of the things that actually came up is the central bank buying back bonds, and that changes the actual policy rate, or the interest rate itself. But we'll get to that. What I want to show off first is one of the just kind of the fun things you can do with this is you can custom code in various shocks to see how they implement over time in whatever it is that you're trying to track, and wherever the shock would be that you're trying to track. So I guess before I introduce the shock, just a couple things on the left side. Any variable that you want to track in the macroeconomy, so we can do what do we say? What was the one that we just entered in today? The growth rate. Let's
previous year, real output, et cetera, nominal or real, either one.
Yeah, all right. So, and it is going to run a little slow. I mean, a couple of the reasons too why this just isn't live yet. We're computing multiple things at once unnecessarily, again, because this is the admin version. Thankfully, a lot of the stuff can be pre-computed and kind of already set before you take it. But here's just in terms of the way this model is currently set up. Here on the left side is effectively the rate of change of GDP. Ty, what was the other one that you can put in that shows wages and profits? Do you remember those exact equations?
It shows wages and profits.
Yeah, like profit. Do you know how we've talked about like the Goodwin growth model, and you can show wages share versus profit share? Do you remember the exact equations?
Well, we're kind of showing that on the right graph in a lot of ways.
Okay.
So
okay.
In terms of income, so profit. So on there right now, households are pretty high. Like, we just kind of put this plot together, but the blue line is rich people, essentially. The blue line is the profits, the share. So the economy has total income 100%, and each agent in the economy, depending on how to divide it up, has a share of that income. So that's kind of the plot we're showing there on the side. So that's kind of what you were asking there for, Doug.
I guess I was thinking of, do you know in your Goodwin growth model, you have firm share of profit and labor share of profit that cycle back and forth?
Yeah, that's essentially this right there.
Is it? Okay.
So,
okay. I guess I was thinking of something different, but whatever. It doesn't matter.
It's because we've in that model, it's just the two cycling back and forth. So it's very apparent that they're inversely related. If you look at it, though, you will see profits. The profit share will go up, and the household share.
Okay, you are right. I see what you're saying. Yeah, I see what you're saying.
Yeah,
okay.
It's just not as distinct because we've layered it so much. And remind everybody, this is like, if there's a version 1 of this simulator that we're going to launch, this is beta 0.001. So do not judge the interface. It is, early days.
What we can do, though, so growth is probably a good one to show this on, or the growth rate. What we can do, we've built in the pandemic shocks on the left panel here, is where all your shocks, where all your various settings, the controls are going to be at when we finally get this thing off the ground. But what we can do is we can actually effectively induce. Oh, it's gonna mess this up. Hopefully that didn't mess it up. Hopefully I can save it here. We're going to run the pandemic shock here, and then just kind of show how this thing operates and kind of what you're going to be able to do in terms of the outcome. And all right, this is awesome. So we'll go ahead and bring up, so this is growth right here, and the light blue line, that's the stable run. It never changes. That's the initial run that started the baseline run. And then you can see in 2025, when we induced the shock, we see growth plummet, the cycle continues, and then 1 year later in 2026, when we let the shock go, we see the growth rate continue on, and then it goes off in its whole new trajectory. And again, these are all the sort of dynamics and the sort of things that you can input into the model to demonstrate, how different things are going to play out. And also, although the actual, well, you know what? It makes me wonder. Ty, you said if I just go.
So you want it, and take that one, and so it's a little tricky because now we're showing the shares from. There we go.
Yeah, so I mean, we can actually just look at each one of these individually and show that the shock made capitalist share jump higher when the shutdown occurred, dropped, went back. The FP is firm share, which dropped initially and then popped back. The household share initially dropped and then popped back.
So when I was putting together the shock, I didn't fully put it together because we're going to make kind of little plug-in shocks that people can use. I didn't put the full shock together. The other part of the shock is the government gave mass amounts of money directly to the household. So that's not showing up in the data right now. So it's not a full realistic shock. Just put it together. And now that I'm thinking about it, I'm like, oh, damn it. I really wish I put it all together. But so there's dynamics missing. But I think you're getting the point. You're seeing a different dynamic temporally down the road that's not intuitive, that you would expect would be something else. And that's system dynamics.
I'm going to reset the lockdown shock, and hopefully that will allow growth to reset. One other thing too that I know we can do. Well, no, just a couple other ideas once this resets as well. I'm going to find like government spending we'll have a control over, and I mean we'll get these. So actually, let's just jump once this fully resets. I might actually just give it a refresh. Okay, we're all set. Ty, how would I demonstrate? We wanted to show the interest rate, the effect of. Yeah. Do you have any thoughts on that?
Yeah. So take out the y subscript r percent variable, and then look up interbank lending. It's the representative of our policy rate in this model. I think it's called interbank. Hopefully, we didn't lose our naming convention on it.
Do you remember what the? Do you remember?
No, I have no clue. Hundreds of variables. I have no clue.
All right, maybe this will be.
Oh, hold on. I'll find it if you can't find it.
Yeah, go for it. I'll look at it.
Just try interest rates and see if the 3 come up. Oh, it might.
Bank interest rate.
No, that's going to be kind of the market interest rate.
Bond interest rate. Real interest rate.
Oh, see, they've been. Oh, scroll up. There we go. Real interest rate. It should not be real interest rate. That is the interbank lending rate.
Okay.
Yeah, we've got to do some work. See, we don't have really any assistance, guys. So, we got a lot of typing to do.
What were the other ones you wanted to bring up?
Hold on. Let's see that chart.
Yep.
I'm not confident that's
pulling in the
correct.
right thing. Okay.
Yeah. I'd have to kind of look at the original model and.
All right, we'll make that our homework for next week, where we can show. We know some of the names of the variables got messed up. And I was just going to look at one more here, not showing up. Some of the names of the variables were messing up. One that I know that, well, we'll make it a thing for next week. Either way, I at least wanted to show this off, let everyone know that if we're going quiet, there's a reason for it, and that we're going to have this hopefully in the coming weeks, very soon in a position where you guys can get your hands on it. We have a lot more that we want to include with the entire model, and the good news is though that we have all of the dynamics baked in there. We just got to get the entirety of the functionality working to a point where the end user can have an enjoyable experience playing around with everything.
So also, with this model, so we're showing kind of some qualitative models. We're going to have a couple different levels, obviously the free version, and then some for the, AppliedMMT members. We're also working on an actual forecast model based on this model that's actually going to forecast. And eventually that's going to tie in with the deep learning model. And that's kind of the big thing we're working towards, right? And where these are essentially educational tools we're providing. So it's, these are the qualitative, what are the behaviors when you raise interest rates? What are the behaviors if you lower or raise taxes? What are the behaviors between government spending on firms or government spending directly on households, et cetera, et cetera? But ultimately, this model can be used as an actual predictive tool in a real economy. And then integrate that with some deep learning tools that already exist at AppliedMMT. And that's the granddaddy of them all. There's nothing out there like that in the world, in the market world, in the macroeconomic world, in the microeconomic world. It's completely novel stuff. Nobody else is doing it. Doug and I, however, are doing it.
Yes, I'm super excited, one, just to throw this screenshots of this at our favorite people on Twitter and X that tell us that we're wrong. I think this will be fun for that, but obviously for the investment research side of things, it's going to be a super powerful tool. So I'm excited for that. Ty, I'm going to try this one more time. Does this look right to you by any chance? The pop in, this was government bond interest rate.
Yeah, that looks right. So basically, because I have it set at ZIRP right now, when I did a lot of research into how bond prices, long bonds and short bonds react to the policy rate, I realized that there's a lot of substantial papers that say that yes, the market rates for yields really follow the policy rate. There's obviously permutations like through market dynamics, buying and selling these bonds on the secondary market, but ultimately it's decided by the policy rate. So bond yields are kept really low because I'm in a zero interest rate environment. They'll pop up when there's demand for them, like you see there. So if you were to change,
I pulled it up, the central bank bond purchase function.
Yeah, change it down to 0.08. Change it to that.
I'm gonna inch it lower just because of the issues we've been having with the solver, and just see how it computes. We'll take baby steps here.
Yeah, let's see what happens here. That's how much confidence Doug and I will just do this live, right? We know it's going to work anyways.
What I've got to do is we're making progress here. So I will just go down to 10 now. Again, everyone, just so you know, it takes. Oh, there we go. There we go.
Oh, now you're seeing, the policy rate has pushed up all the other downstream rates. And it's too bad we don't know which variables the policy rate variable, but you would see if it was on screen a big bell curve in the policy rate going from zero and to about 2022, 2023, where it peaks. And then mechanically, like I was saying before, just the way the economy is engineered, all policy rate, the interbank rate tends down to zero. That's the only way it can happen without intervention from either the central bank or the government spending more, right? There, remember, as much as we know central banks are independent versus other departments in the federal government, the New York Fed and the Treasury are talking to each other every day on policy decisions. So they work hand in hand. But if neither one of them does anything and the government just keeps spending more and the Fed, the New York Fed's just buying a pre-described amount of bonds from the banking sector, rates will tend down to zero. And you don't see it there, but that's why you see the dark blue line is shot way up there because the policy rates have pushed,
which is the simulation
all yields.
Yep.
Right. And then later down the chart, you notice there's not as much difference. That's because the policy rate's down at zero. And it's really too bad we can't display that graph because then people would have an understanding.
What did you say the policy? What did you think the policy rate was?
Well, it should be one of the interest rate. I think it's IN subscript R, I think.
There is an IN subscript R. So interbank lending, interbank lending rate.
Yeah.
All right.
Yeah.
All right. This is what I wanted to show earlier. Is you can we have it so you can plot these on separate axes as well, and we'll pull this up. Give it a second to compute. Well, it does. I'm seeing some good questions. Does deep learning mean that the BIS that we're going to have real data? Yes, that is exactly. I mean, it's exactly what it means. Yes, real data is the most important part of all of this. Do you have capacity utilization rates, inflation? Yes.
Yes. So so capacity utilization is a big feedback loop in the productive part of this model. If I'm assuming what Dan means is capital utilization rate of fixed capital in the productive sector. Yes, that's in there, and that's a big part of the dynamics.
So again, what you're looking at right now, and Ty, I can kind of clean this up. And
that is not the
that's not the right one. Okay.
No, it would look like a bell curve. Let's try the other one that I think is. Just type in interest rates, and it'll, I think, bring up another one potentially. No, BR. Try BR. Yeah, try that one. B subscript R %. Try that one. One day we'll get these named right. Let's see if this one's right. That one, it's just.
Okay.
I don't know what's going on there. Next week.
We'll all right. I mean,
we'll have a better demonstration.
It's we're very close, and
wait. Oh, you know what? I realized you had it on separate axes.
Do you want it on want it on the same one?
Yeah. Try it on the same axis to see what it looks like, if that's the right one, which it may or may not be.
It's a 50-50 shot.
Yeah. And what are we we're measuring it against. Yeah, that's going to kind of screw up the axis because we're actually measuring the actual amount of interest being paid. Yeah.
All right.
Yeah, we'll prepare this next week.
We might even have it prepared by Saturday. So if you want to discuss that, we'll definitely be looking to.
So we're back. I know a lot. I can see the names here. So Stephen Friends is back this Saturday. I don't like promoting it on Doug's channel because we want to make sure you guys come back here every week. But nonetheless, Doug and I are going to be on Steve and Friends this coming weekend, and we are going to be doing another demo. And hopefully by then, because Doug and I are pretty efficient once we get in there, it's probably going to be a magnitude greater on our development. So check us out. That's at 9 o'clock Pacific time, 12 o'clock Eastern time on the @Prof. Steve Keen YouTube channel or on YouTube.
You mean Twitter?
I'll put tweets. I'll put tweets out about it. I'm sure Doug will mention something. So, so we'll get a longer, hopefully a more fuller scope there, because hopefully by then Doug and I will
we're making a lot of progress. Ty was like, I don't know if it's ready to show. I don't know if it's ready. We obviously to get all this done, we rely heavily on all the tools that are available, and sometimes those tools, AI is specifically what I mean. It went ahead. We had all of our names defined and everything exactly how we wanted them, and AI decided that that's not exactly what we needed, and that's why we couldn't find exactly what it is that we wanted to find as we were going live, because one of the core functions we were trying to update, while we were doing that, it completely decided to rename everything. But answer a few more questions. Will you use real world data to allow it to be predictive for future business cycles? Yeah, that's exactly what the game plan is. The whole thing though too is, you can't, obviously predicting where things are going is very helpful, but you need to, it is healthy to understand any prediction that this thing is going to make in the context of the qualitative understanding of how the macroeconomy operates, right? And I'm not trying to say that the quantitative output is not more important. It is, a lot more important to the decisions you have to make, but you're going to want to understand qualitatively what the macroeconomy is doing, and that's exactly what we just showed off, is that you can still simulate those outcomes using kind of a baseline as your baseline, to then understand what shocks will be, or what policy decisions will be, and how those will affect over time, to give you context for the sort of forecast that would be generated from such a model. All right. Yeah, the AI renamed the data LMAO.
Yeah, so, I saw that, and actually, so Doug and I, we use AI. Doug's a real good expert at using that, and it's basically saved us from hiring at least 5 people, I would say, legitimately. And one of the earlier translations of the Minsky-Ravel code essentially turned the entire model, equations including, into a neoclassical DSGE model. Because here's the thing, this is novel stuff. So like AI, the tools we use, they know DSGE models. They've learned that language. They don't know, the strong heterodox theories out there. So hopefully Doug and I have changed that. We've probably I'm hoping, the next time, a group of neoclassical individuals are online using it to try to develop their equilibrium model, that all these heterodox terms come up and just cloud their whole model with reality for a change. That would be great. So hopefully that's, something that's been achieved by Doug and I, giving AI all this beautiful information about economics.
Yeah, I doubt it. I bet it will. I bet it is programmed like the rest of the world to just listen to the Larry Summers and the Paul Krugmans of the world. But not gonna hold my breath on that one. One of the questions that came up, and I was just playing with this. I can't wait for you guys to be able to get this in your hand, because like someone was just asking, is inflation possible? And literally I just popped inflation on here, and the only difference, Ty, is the bond purchase is on here, and I'm seeing a distinct change in inflation here in terms of the trend. I don't know if you have any thoughts on that, if the bond purchase itself was going to do anything to the inflation rate.
So what's happened theoretically, if all the graphs are right, if there was that bell curve in the first part, so to the left side of your chart, that would have pushed rates up really high, and it would have kind of crushed the economy because I got Doug to lower it pretty low. Like we're talking the policy rate probably went up to 20-25%. So over the long term, you're noticing the economy, essentially it's telling us, well, the economy's just was at a lower trajectory from that point forward. We put families out on the street in a metaphorical sense in the model. So that probably explains it, but without actually visualizing what we did, I'm being subjective.
Okay.
And you know what? That just says the scope of the model. Even the designer is, there's 37,000 feedback loops. So we got to name some parameters, the right names, and we're going to get this.
I am curious what happens if I reintroduce with what we currently have. Maybe I can just finally break it if we can see what the I reinstituted the shock here, so.
Ooh, okay, so what are we this is inflation, right?
Still looking at inflation here. So we instituted the shock in 2025. And remember, the dark guys and gals, the dark line is the custom run, and then the light blue line is the baseline. And so we instituted the shock in 2025. Inflation completely collapses. We release the shock in 2026. And during the prior run, we were actually seeing pre-shock inflation compress, but now we're seeing inflation, the cycles at least, expand in their amplitude. I don't know if you had any thoughts.
Well, that's exactly what happened in the pandemic, right?
Yeah.
And even in the simulation that we put together a few weeks ago,
yeah,
which was a more detailed, where I actually worked at the parameters. This is just showing, though, if you literally, so Dan was mentioning capital utilization. It is one of the functions that I adjusted the shock for. So if you shut down 20% of the economy and you augment that, labor productivity goes down at the same time, stuff drops like that. That's what we saw during the pandemic. We saw negative $20 oil prices, Texas crude went negative $20 somehow. So you see a disinflationary environment. When you turn it all back on, there are lags, lack of supplies, and foreign constraints, and you get inflation. And that's what this model demonstrates. And this shock is without, this is another highlight here, even without all the fiscal spending by the government, there was still going to be inflation. So all the,
oh, that's wild. Okay.
The hawks out there that say, oh, it wasn't the pandemic that caused the inflation, it was all that extra government. No, it's structurally, there was not enough supply when we came back online.
That's crazy.
And there was going to be inflation. There's an argument that inflation went up a little bit more because of the extra stimulus. But think about it. People were paying their mortgages off with that stimulus. Imagine if we had a banking crisis right on the heels of a pandemic crisis. So, the dynamics show it that there was going to be inflation no matter what. We shut down the global economy. I don't know why people don't understand that, right? And so mechanical models like this are going to show that, right?
Yeah.
It's not based on hyperbole. It's based on just the mechanical feedback dynamics. So they're all intricate. You can't argue with it. It's just a reality, right?
Ooh, this is exciting. I'm going to leave it on this cliffhanger right here because this is exciting. I'm glad we looked at inflation last and put that shock back on just to show that, in fact, this model will do exactly what it is you would expect to happen and what played out in IRL. Okay, man, I'm like writing notes for things that I want to show for next week, maybe even by Saturday. So make sure you show up. I'm sure everyone watching this will know and be ready to show up to Steve Keen and friends. I'll pull up that channel. I mean, you guys know. You guys, I don't have to tell. And it's been a while since they've done a live stream, correct? So this will be kind
Yeah,
of a
yeah. We've decided we break it off in seasons now. So we take the summer off.
okay.
So it's going to be you and me, Doug. We're bringing the show back online for
Nice.
season 3.
Nice. All
Right.
right. I'm excited. I'm excited to be there, and we'll show off some what we're able to pull off this week. Let's see. That's what I've got for tonight. Chat, you guys were great tonight. Really enjoyed the questions, and I really enjoyed showing off the model. And we're gonna have a lot more to come. It seemed like there was a lot of interest in terms of what we're developing. So I'm excited to keep the development going, and eventually, hopefully in the not too distant future, get something in everyone's hands to be able to play around with, and get it on Twitter to show off. And yeah, kind of raise the stakes for what the expectation is for how you do macroeconomics, and of course kudos to my co-host here on the live stream, Ty, for having the genius that it takes to come up with such an intricate model. And I'm pumped. Ty, go for it, man.
Yeah, and so Doug is pumping me up right now, but really we've taken it to the next level because Doug has some pretty superior skills in porting models over to Python that I would have never been able to conceive myself. So it's a 50-50 effort, both of our parts, right? So it's, we Doug serves his purpose, I serve my purpose. We come together and we make something pretty damn special.
I agree. It's been fun. We've learned a lot too. Part of the exciting thing too is we've learned some really cool things already. We're discovering more very cool things. I think the best part of this is that we're going to have a lot of fun things to share, a lot of really interesting things to share, just in terms of insights of how the macroeconomy actually functions. And that's what this is all about, right? We want to understand how to build as accurate as forecast as possible, and the only way you can do that is by getting deep into the understanding of how macroeconomics functions to create the predictive models that we are. And it feels really fun to be on the absolute cutting edge and the only people coming anywhere close to doing any of this, and to get to share with all of you out there. So with that in mind, great stream tonight. Really excited for the future, and I've got nothing else. So until next time, good trading, everyone, and we will talk to you all then. Have a good night.